am Dr. Tendruthi, going to present my e-content on the topic Holding Company Accounts. Before knowing about holding company accounts, we must be familiar with the term holding company. The holding company is a company which has a control over another company by either of the control over the composition of its board of directors or holds more than half in nominal value of its equity share capital, that is more than 50% of shares in another company. For example, if we have A and B company as example, there is in B company 5,000 shares. If A company acquires 4,000 shares, that is only 80% of shares acquired by A company. In such a case, that A company is said to be holding company. Next, what is subsidiary company? Subsidiary company is a company in which holding company has the control over the composition of directors or holds more than 50% of its nominal value of its equity share capital. Next, we are going to prepare the accounting for the holding company. Here, while considering the accounting treatment, the holding company is preparing the accounts as per Accounting Standards 21. But it is not compulsory for every company, holding company, to prepare as per Accounting Standard 21. Only ICAI insists the holding companies to prepare the accounts as per AS 21. Before the preparation of, in the accounting treatment, the holding companies are preparing consolidated profit and loss account and consolidated balance sheet. Consolidated profit and loss account and consolidated balance sheet. Here only the form consolidated balance sheet format is different to be learnt. Before the preparation of consolidated balance sheet, we must be familiar with certain concepts. They are minority interest, capital profit, revenue profit, goodwill. Yes. What is minority interest? In case of subsidiary company, as we have the example B company. In B company, A company holds 4,000 shares. In such a case, remaining 1,000 shares held by the outside public. The claim of outside public in the subsidiary company is said to be minority interest. The amount to be payable, that is claims to be payable to the minority interest, only find out by using this formula, that is computation of minority interest. How to do the calculation? First thing, we should take the face value of minority equity shares. And in the subsidiary company, how much shares, equity shares held by the minority outsiders to be taken. Then the face value of minority preference shares held by the outsiders to be taken. Then minority share of capital profits calculated and taken. And minority share of revenue profits calculated and taken. Then minority share of preference shares, if it is issued, to be taken. All these amount to be totaled, and from this total we should subtract, is there any capital loss or revenue losses. In that capital losses and revenue losses also, minority share to be subtracted. Thereby we can arrive at the minority interest. Next, the term we are going to know about capital profit. capital profit is nothing but the profit earned before the acquisition of shares by holding company in the subsidiary company. So, before the acquisition of shares by holding company, the subsidiary company may earn some profits. That profits only be termed as capital profit. For finding such a capital profit, there is some workings. First we should take into account general reserve, capital reserve, profit and loss and other reserves of subsidiary company on the date of acquisition of shares by holding company. And from the reserve, if we use it for any bonus issue or dividend payable by the subsidiary company to be subtracted. And along with that, we should add the subsidiary company's profits during the current period before the purchase of shares by holding company. And along with that, we should add the profits on revaluation of assets and liabilities of subsidiary company on the date of shares purchased by the holding company. And from that, we should lastly subtract loss on revaluation of assets and liabilities of subsidiary company on the date of purchase. Thereby, we can arrive at the capital profits. And next calculation is calculation of revenue profit. The revenue profit is also termed as post-acquisition profit. The post-acquisition profit is nothing but profit earned by the subsidiary company after the acquisition of shares by the holding company. For example, if the date of acquisition of shares by holding company is on 1/4/2022 and if they acquire 9,000 shares at rupees 100, 3 months there is a pre-acquisition period. That is, before the acquisition of shares by holding company, there is 3 months. And remaining 9 months will be the post-acquisition period. For the post-acquisition period only, we are going to calculate the post-acquisition profit. Let us assume the profit for the year 22-23 is 10 lakhs. So, in this current year profit, we should compute 9 months profit, that only be termed as revenue profit. So, we find that 9 months profit on 10 lakhs, that will arrive at rupees 7,50,000. So, that is the revenue profit or post-acquisition profit. So, in short, we can say post-acquisition profit is the profit earned by the subsidiary company after acquisition of shares by holding company. This is the workings. And next, calculation of goodwill or capital reserve. Here, holding company is acquiring the shares from the subsidiary company for consideration. So, for such consideration, we are going to compute whether they are paying more or whether they are receiving more at the time of acquisition as goodwill or capital reserve. For that, there is a working, that is, for calculation of that goodwill or capital reserve, first we should take into account amount paid by holding company as consideration. Along with that, if there is any capital loss accepted by holding company to be added, and from that we should subtract whatever the forms of benefits received by the holding company to be deducted. First thing, face value of shares purchased by holding company to be deducted. Next, holding company share of capital profit to be deducted, and if the holding company receives bonus share, that share to be subtracted. Then if they receive any dividend at the time of acquisition, that dividend proportion should also be deducted. Thereby we can arrive at goodwill or capital reserve. That is, if they receive more, the answer will be the capital reserve. If they pay more, that answer will be the cost of control or goodwill. Yes, if you thorough with these terms, we can go to the workings, that is preparation of consolidated balance sheet. We will see in the next video. Thank you.